In this week's episode of the Stockscores Market Minutes, I'm going to talk about whether you should use stop losses, whether they work in trading. I'll then do my regular weekly market analysis as the market moves to new highs. What does that look like for the future? We'll do a market scan in search of opportunities, and I'll look at the day trade of the week on BILI. All right, so do stop loss orders work? Well, first of all, what is a stop loss order? If you own a stock, you can put an order with your broker to sell that stock if a certain price is hit. So for example, let's say you bought the stock at $10 and you want it to be sold if it falls down to $9, effectively losing 10%. You could put a stop loss order that says fill this stock on a sell at $9 if the market hits $9, and you should get out close to that. You can do stop limit orders, which means there's a limit to how low a price you take. And then there are stop market orders where you just get filled at the prevailing market price, and that could mean some slippage, but at least you're guaranteed to get out. And so that's basically what a stop loss order is. Are they a good idea or not? Well, I will say that it is a very good idea to limit the size of your losses. There's no doubt that we don't want to take really big losses in our portfolios or in our active trading, because those big losses will outweigh many different gains. And so I think it's always important to limit losses. However, the use of stops is actually dangerous, because if you don't do it correctly, you put those stops in the wrong place, then you really lower the probability of success with your trades. So most people will set their stops too tight, and that, as I said, lowers the probability of success and really negatively impacts their performance. As an example, I've got a big database of all of the stocks that have triggered my day trade entry signals. It's all algorithmic, as you probably know watching this video. And I can test different stop loss levels. Well, if I put a stop loss level at -1 RR and compare that with using a wider stop at, say, -3 RR, the total performance is actually doubled by having the wider stop. So in other words, if I expect to make, 1 RR per trade on average with that wider stop, with the tighter stop, it actually drops the average by half, like down to 0.5. And so that's a huge difference in your total profitability, even though in some ways you'd think, well, I'm not taking as big of a loss, therefore shouldn't my overall profitability be better? Well, no, it doesn't work that way, because you end up getting out of good trades because you had a stop that was too tight. And so when you think about where to put stops, you want to really use the price floor that the market has established and go just beyond that. So we use a day trade as an example. This is a day trade from Friday on Apple, and the entry candle was right there. You can see the little pink dot, that's my action candle. So where would you put the stop there? Well, if we use a -1 RR, the stop is going to be really tight right there. And I'm going to tell you that that's too tight. It worked on this stock. Apple never tested that support level, but it really was too tight. What I like to do is look at the last point where the market stopped going down and started going up and use that price point. And that to me was the good floor on Apple at 247.62. You can see that price there. And I'll typically go just a little bit below that. So for example, maybe 247.59, a few cents below, just to give a little bit of an extra buffer. And what that translates to in this particular trade was a -2 or slightly more than -2 RR stop. Now sometimes it could be -1.5, sometimes it could be -4. You have to look at where that support price is and let that determine where to put your stop. If you use stops that are too tight, I guarantee you your overall profitability will really suffer. Even though you're taking nice small losses, the probability of success really drops a lot. All right, let's get into this week's analysis, starting off with the S&P 500, which has had a pretty good week. We moved higher, and at the end of the week, we were at new all-time highs. So you can see the nice upward trend that's in place. We have this sort of upward sloping channel. We're up near the top of the channel. Recent breakout to new highs tells me that we could see a little bit of a pullback near term, but I think generally speaking, we're in this upward trend, and therefore I would remain short-term bullish. When we look at the longer term chart, we can see that we've broken through this resistance level. That's a positive. My only concern is that we're also at the top of this channel. And if I draw a line sort of across those, you can see that we're right at that line. I don't know that that's really important, because I don't think of this as a real true channel, because it had this in the way. And I think that there's probably a lot of people who have been shorting the market. With all the negative headlines out there, a lot of people shorting the market. And as the market goes to new highs, those shorts are scratching their head going, uh-oh, we're getting really big losses here. And they scramble to cover. And that's why a market that has a lot of negativity, a lot of doubt, I guess, often surges higher that much quicker because there's a lot of short covering. So I think that this is a good long-term bullish chart. Yeah, it wouldn't surprise me if we stall for a week or two, but I like the market longer term. On to the Russell 2000, this is the daily chart, and you can see here that we've got some resistance that's formed. We've hit it so many times, and we're coming up to it again. We've rallied into it, and so that tells me we probably get stuck there, at least for a few days. What I'd like to see is for the market to go sideways and around that 158, 159 level, and then break out through that. That would be a breakout of this sideways trading pattern and really be a good sign for those small cap stocks. I like to call this my retail trader index because smaller retail traders tend to play lower price stocks. They like those small cap names because they can move quicker. And so when this is moving up, it tells us that that retail investor is gaining more confidence. We haven't broken out yet. It's really lagged the S&P 500, but it's starting to get there. And I've certainly noticed that there are more and more small cap stocks starting to trigger some entry signals. So some reason for optimism, but don't get too excited until we can break out of that range. On to the Canadian markets. Let's take a look at the TSX 60, which is really lagging the S&P 500. It was doing better earlier this year, and now it's lagging. We did break this little flag pattern, so we broke out through resistance. That was a good thing. We pulled back into a flag, and now we've broken the flag. So that should lead to higher prices as we sort of build that rising bottom here. Optimism is building. I think this is good, not great, but it looks fairly positive. I think Canadian stocks can maybe start to play catch up. When we look at that shorter term chart, you can see that we had that breakout on Friday out of this trading range. We still have the highs from over there. That's a bit of a concern, but I think, with the little flag on the Friday's trading as well, I think the TSX wants to go higher, and you can probably nibble at a few different opportunities there. Now, TSX Venture, totally different story, pretty ugly looking market. And I think you got to be real cautious with the Canadian microcap stocks, those junior miners, cannabis names, junior oil and gas. They just don't have any life right now. And so be really selective with stocks you trade on this market. On to currencies. Starting us off with the US dollar. You can see we've got this nice upward sloping channel that we've been in for some time. I didn't draw that perfect, but you get the idea. Kind of down around the bottom of that channel, so we got a little bounce 2 weeks ago. Haven't really followed through from that. I still think we're in a bullish trend and therefore be bullish of the US dollar, but if we break that upward trend line, then get a little bit nervous, and we're sort of testing it now, so it's important to keep an eye on this chart if you're bullish on the US dollar because we could see a breakdown soon. Canadian dollar has been slowly trying to reverse its downward trend, and I emphasize slowly. We broke the downward trend 4 months ago. Building rising bottoms, still stuck under that resistance level. If we can break out through this, then we've got what I call a bottom fishing pattern, where step 1, you break the downward trend line, step 2, you build a rising bottom, and step 3, you break out from the rising bottom. And so there is the potential there for a bullish situation in the Canadian dollar. For now, I'd say it's neutral, but it's certainly better than it was 4 or 5 months ago. On to interest rates. And this, of course, the TLT, which is a Treasury bond ETN. And it is in an upward trend. We went parabolic, ran away from the trend. We've come back to it now. So far, we are bouncing, and we'll see if we can continue higher from that upward trend line. Generally speaking, I think we're probably going to head sideways with the bond market, which means interest rates should start to stabilize and stay low, but probably not get a lot lower near term anyway. On to commodities. And of course, we always take a look at gold and oil. First up is gold. We have that upward trend. We have a flag. We broke the flag, and that maybe indicates that we're going to move higher from here. My reservation is that there's not a lot of enthusiasm on that break, so I'm not sure how strong of a move out we're going to get, but I'm feeling a little more optimistic about gold. I was a little pessimistic for a while again, but in the last week or two, I'm starting to see some signs that we could surge higher. We just need to be fairly selective still. Now, oil is interesting because it has actually been trying to hold some support. You can see how we've been bouncing off of this support level, and we did that there. And the downward trend line is still intact. But if we can break that downward trend line from this stability, you may see a little recovery in oil. So I I think it's got potential. I wouldn't get too excited yet, but keep an eye on it because if oil breaks, then the oil stocks will be next, and we want to keep an eye on those. And finally, the fear chart, VXX, is at lows. Always remember that even though this looks like it's much lower now than it was here, it's kind of the same because there's time value decay in the pricing of this ETN. And so this is low, they're all low. Like it's a really relative to its more recent past. Essentially what we're seeing though is that investors are not buying insurance against market volatility because the market's moving to new highs, and that's just the nature of the beast. So my ratings then, bullish on both time frames for US stocks. Canadian, I'm only bullish in the short-term time frame. I think there's still some work to do longer term. Gold, neutral both time frames, and oil, neutral long-term and bullish short-term. US stocks have broken out to new all-time highs, and they should continue higher in the weeks ahead unless there's some dramatic and negative fundamental event like a breakdown in trade talks with China, for example. Canadian stocks are lagging, but they're starting to show some life too, and so we have some promise there. Oil is trying to break that pessimistic downward trend, but it hasn't done so yet. Keep an eye on that. And gold still has some potential. I think you can keep an eye on it as well, and maybe we'll get another run in gold after it's been quiet for the last little while. Fear, as I said, is low. All right, let's jump over to the Stockscores market scan tool. This week I'm going to run the action break scan, and this particular scan looks for stocks breaking pessimism with some abnormal activity. So stocks that are in long-term downward trends but are coming alive with some buyer interest. And it's maybe a lower probability strategy, but when it works, it can really work. So here's an example. This first stock, it's real cheapy. It's only 12 cents, 12 and a half cents, but it's got a nice chart pattern. It has broken this downward trend line and been pretty stable the last couple of months, and then broke out from that little sideways trading range. Now, there's a few things you have to be concerned about. One, this is on the OTC market, which is not a great market for trading. It only traded 252 times, so it's really not a very liquid stock. So it's kind of a long shot for the really speculative trader. I wouldn't consider it for most people. But we can continue along. Just again, this is the weekly chart of ONVO, and that doesn't look all that great, but when you zoom in on the 6 month, you see a very similar pattern to the last stock, where you've got this lengthy sideways trading range. We've broken that downward trend. We're coming alive. My worry is that this trading range is going to provide some resistance, so I don't know it's got a ton of upside. I like that there's a lot more volume traded, 2,598 times on Friday. I'd give this one a 6 out of 10, not higher because of this resistance that I think may hold up. And moving along. Don't really like that. You'll notice I'm looking at the weekly chart first. In some instances, I have to zoom in on it because the scale is so out of whack. So here's a stock that was very abnormal on Friday, really strong volume, but in the context of its longer term downward trend, it hasn't broken that. And that's probably why it failed to hold the gains that it had in the morning. It fell off and ended up closing pretty much near the open. So that's a case where, using these chart patterns is really important, because if we can see that, that pullback or that bumping up against resistance at downward trend lines, it usually holds up, and they're not good stocks to buy. All right, let's take a look at this. The weekly chart looks pretty good. It's breaking its downward trend line on the weekly. Take a look at the 6 month daily chart, and you can see that we have broken that with some volume coming in, some price action. That's not bad. Again, my worry, this trading range over here, there's going to be a lot of supply of stock, around $1.60 a share. So it doesn't have great upside potential. I think it's good, but it's not great. I'd give it a 6 out of 10. We'll do just the last few on this page, and then we'll move on to the day trade of the week. I have to see something promising in the shorter term chart for me to blow it up. So HYMX or HIMX, yeah, it doesn't really have enough on the weekly. What I'm looking for is a break from some low volatility pattern, and I don't really see anything on those others. All right, so let's jump back into the presentation and look at the day trade of the week. And this one is a stock that I highlighted in my active live on Friday morning. There's the little pink dot there. You can barely see it. And that is our action candle. This is a stock that nobody cared about, and it came alive with some volume. So that's why I picked it, highlighted it. And the economics, for $100 of risk, it required a position of 1,110 shares. That is a $17,760 trade, but remember, you can margin these 3 to 1 with most brokers if you're active trading. So that's $5,920 of capital On this trade, you make $520 gain. Let's call it 500 because it's going to have some slippage with commissions and that sort of thing. But still, that's an 8.5% return for a one-day hold in a very liquid, easy to trade stock. And just to go back to the idea of where do you put your stop here, I would, if I'm buying it here, I'd have my stop down around this range because that is the old floor before the price started going up. All right, well, that has been the Stockscores Market Minutes for November 4th, 2019. I hope that you enjoyed it. If so, click on the like button, leave me a comment, and most importantly, trade well.